Hello everyone, welcome to today's episode of Boss Economics World. I'm your host Boss, and boy do we have a hot topic for you today. As usual, we'll be digging deep into the economic problems that our dear governments are burying themselves, and us, under, with a special focus on Japan, which seems to be repeating the same economic mistakes over and over again. If you think things are bad now, wait until you hear the latest developments and what they mean for the grander scheme of the global and national economy. So, what's hot today? Well, we're talking about why Japan is on the edge, the changing tides of BoJ, Bank of Japan, monetary policy, and whether or not Japanese policymakers who like to pretend they know what they're doing can handle the mess they've plunged themselves and their populace into. Spoiler, it doesn't look promising from where we're standing. Now let's start at the core of the issue, monetary easing. Since the early 1990s, Japan has been living in the shadow of the infamous bubble burst that led to the lost decades. And what has the Bank of Japan done to tackle the problem since then? It's thrown everything at the problem, with little success. The nation has been trapped in an ultra-low interest rate environment for over 2 decades. Heck, if you add up all the stimulus poured into this, it's beyond elephantine, but for ordinary folks, everyday life hasn't exactly improved, has it? And now, the BoJ is caught in a dilemma. Toyoki Nakamura, one of the bank's most cautious, some might say, dovish, members, made some critical comments recently that reflect just how fragile the situation is. He's urging caution, urging the BoJ not to raise rates too quickly or too aggressively because Japan's economic recovery is about as decisive as someone choosing a Netflix show on a Friday night. It's just, tentative. Here's where things get interesting. Nakamura's remarks suggest that there isn't even a consensus within the BoJ on what comes next. While the governor, Kazuo Ueda, has been dropping hints about rate hikes for months, Nakamura's temperate tone is a sign that not everyone's on board. Now, let's think about this for a second. How did Japan get here? Well, the core of the problem lies in the extremely skewed economic composition of Japan's modern economy. 1. Aging population. Japan's population is declining and rapidly aging, putting immense pressure on pension systems and the labor market. More seniors, fewer workers, and hence a heightened burden on government finances. 2.0 Interest trap. Years and years of ultra-loose monetary policy, primed to kickstart the economy, has failed to lift inflation sustainably above 2%. The prolonged low-interest environment has caused prices to stagnate while creating debt-financed zombie corporations. And all the while, businesses remain reluctant to invest in ways that accelerate growth. Who's going to risk capital when growth prospects barely scrape the floor? 3. Wage growth. Not so fast. Nakamura also raised doubts about the sustainability of recent wage increases, not seeing enough momentum beyond 2025 to keep the economy on track. Japanese workers are not enjoying increasing wages the way central banks might hope. Without higher wages, consumer demand remains restrained. Simply put, without more money in our pockets, who's going to go out and fuel the economy through spending? 4. Dwindling corporate profits, and what about the corporate side of things? In the latest quarter, for the first time in 7 quarters, corporate profits declined. More notably, small businesses, that crucial engine of steady employment across Japan, saw profits dive by 22%. A staggering figure. Do you see the cracks forming? Okay, so let's imagine that the BoJ, in its infinite wisdom, or lack thereof, pushes forward with a rate hike. What happens next? First, the yen could strengthen, right? That would sound like a good thing since Japan's been suffering from a weak currency for a while now. In fact, following Nakamura's remarks, the yen weakened instantly on the prospect that December's interest hike may be delayed. It's funny how jitters can immediately send the market into a tailspin. But do rising rates automatically fix inflation? That's where things fall apart. You heard Nakamura, I'm not confident about the sustainability of wage hikes. If wages aren't rising, even with inflation temporarily slowing down, real economic recovery can't be sustained. Crucially, Japan's inflation problem has been one filled with imported cost push effects. We're talking about rising prices due to external factors like higher import costs rather than a domestic demand boom. Rate hikes could choke off investment just as the economy starts showing fragile improvements. Anyone else smell a potential disaster? Now, this problem is not just a domestic story for Japan, this scenario is troubling for the global economy. Japan may be relatively insular in its world status, but as the third largest economy, if Japan cracks even more severely, the ripples spread far and wide. First of all, Japan's yield curve control policies have shaped global bond markets. Investors piled into Japanese government bonds, JGBs, because, with rock-bottom yields, it forced money out into other markets, inflating bubbles elsewhere like the US and Europe. A shift toward higher rates, or even the expectation of such, could unwind those positions, causing turmoil across the globe. Also, Japan is a massive player in the currency and trade picture. The weakening yen in past years has both positives and negatives. On the one hand, a cheap yen makes Japanese exports super attractive. This benefits companies like Toyota or Sony, which can stay competitive in international markets. However, it also drives up import costs, especially energy. Japan is highly dependent on importing energy since they shut down many nuclear plants after the 2011 Fukushima disaster. Rising import costs with little wage increase, see how this loops back into the domestic inflation trap. Let's broaden the lens a little bit now. The troubles Japan faces today mirror global trends that are equally precarious. For instance, the US Federal Reserve has been wrestling with its own set of inflationary problems. Jerome Powell recently indicated that given higher inflation, the market may need to brace for another rate hike in the coming months, but, surprise. Worker wages in the US aren't growing fast enough either. Americans, like the Japanese, are stuck in an environment of high prices but stagnant income growth. In Europe, ECB President Christine Lagarde has signaled that inflation remains a major worry, even as the European economy cools rapidly. The European Central Bank faces similar dilemmas around whether to push even further into contractionary territory or let inflationary concerns sit for now. And let's not forget, Europe's corporate profits are also showing shakiness, adding yet another dimension to the continued economic slowdown worldwide. This leads to an overarching truth: the entire world is facing a tiptoeing across a tightrope, with central banks not knowing whether to pull the trigger on rate hikes to combat inflation or to nurture fragile, barely visible economic recoveries. So, where do we go from here? Do we believe Nakamura's caution, or take Ueda's bolder stance that a rate hike is nearing inevitability? If Japan's current trajectory holds and the BoJ makes a misstep, we could be facing another 10 years of sluggish growth, deflationary pressures, and social discontent. After all, the Bank of Japan, despite all the rhetoric about change, has shown itself to be averse to solid moves. The most telling sign is that trader expectations have swung dramatically. At the beginning of the month, over 60% of traders believed the BoJ would hike rates this December, but Nakamura's speech knocked that expectation down to 36%. It's clear that even markets don't believe in the BoJ's so-called decisiveness anymore. What could save Japan? Not small-time tinkering with interest rate moves, that's for sure. Structural reform could work, though that's the eternal prescription for every economic problem. Perhaps more focus on stimulating private sector innovation, culture shifts in employment, and targeted fiscal investments into infrastructure and green energy could help. But that will need strong political will. And if there's one thing the Japanese government has demonstrated over the years, it's a severe lack of boldness in decision-making. If you ask me, the situation is about to get worse before it gets better. Japan is nearing a fork in the road with the uncertain tightening of monetary policies, and the broader marketing conditions globally are anything but ideal. We have been skating on thin ice ever since quantitative easing became fashionable, but the ice is starting to crack, both in Japan and around the world. With other central banks in similar positions, torn between curbing inflation and not stifling economic growth further, the world's interconnected financial systems may feel the brunt of Japan's indecision. Whether it happens in December or January, any small policy pivot could trigger market chaos.